In this presentation, we will continue on with our comprehensive proprietorship problem with the closing entries now entering the final last one, the fourth closing entry of the four-step closing process. For more accounting information and accounting courses, visit our website at accountinginstruction.info. We're currently in the closing entry tab. We've entered the prior closing entries, which are basically to clear out those prior three, cleared out the revenue accounts, expense accounts, all of net income accounts, the accounts that account for or add up to net income, to the capital account. In other words, we closed out the revenue to the income summary. We can kind of summarize this with the income summary account. We closed out revenue to the income summary, making revenue account 0 and putting revenue into the income summary. Then we closed out all the expenses to the income summary, resulting in the income summary having net income in it. Then we closed out income summary, which had net income in it, to the capital account, resulting in all income statement accounts and the income summary account now being 0. Only one temporary account left, one that's not on the income statement, the one called draws. So draws represents the owner taking money out of the company. We're going to track that as it goes, and then we're going to close it out to the capital account. It's not on the income statement. It doesn't affect net income, but it is something that we want to track just on a timing basis to see how much has been drawn out over a certain time. So in other words, the draws needs to go to 0. We're going to have the date, same date, end of the time period, January 31st. Draws has a debit balance. It's a contra equity account because equity typically credits will win. This is a debit, and therefore it's going to bring down equity. It's going to bring down capital. So we're going to do the opposite thing to draws to make it go down, which will be a credit. So I'm going to right click and copy it. We'll put that on the bottom in B20, right click and paste 1, 2, 3. Going to indent, go into the home tab, alignment, increase indenting. We're going to put the amount in the credit side. We could do that with a formula by saying negative of this number. Make sure to pick up this number and not the outer number so we don't have the circle reference. And we could put a little formula here in C19 by saying negative of that number. Then we just need to know what this account should be. And it will be, of course, going to capital. So capital, we're going to right click and copy. We're going to put our cursor in B19, right click and paste 1, 2, 3. Now we just need to post this out. Here's the capital account on our trial balance, on our general journal, our closing journal entry. Here it is on the trial balance. We want to be in the middle column. Note what it will do. It'll bring the capital account down. Here's a debit. This is a credit. Bringing down what is owed to the owner because it's what the owner drew out of the company, thereby reducing the net value of the company and the amount owed to the owner. So we double click on it, go to the end of it, and plus, pointing to that 1,500, bringing this balance down from 105, 100 down by 1,500 to 103. 600 now out of balance by that 1,500. Now we'll post the other side. Here's draws. Here's draws on the trial balance. We are in the middle column in H18, where we say equals. Point to that 1,500. That'll bring us down to 0. So here we've achieved our goal now. We have all temporary accounts 0, including draws, income summary, and all the income statement revenue and expenses. We moved the balance to the capital account. And we can see the activity that happened and compare it to the statement of equity. We'll note that it started at the beginning balance plus investments was already in there. It went up by the net income, which we took out of the income summary by closing revenue and expenses to it. And then it went down by draws. So remember that mirrors, if we go to the financial statements, what we did on the statement of equity. The beginning balance plus investments, and then it increased by net income, decreased by draws to bring us to the ending balance. What we're left with then is, in essence, just the balance sheet. The balance sheet at a point in time. That point in time can be thought of as either the midnight, January 31st, or 1 in the morning in February 1st. All we're left with is a balance sheet. We have no income statement because we want to start from 0, resetting the odometer, making all timing accounts 0, therefore being able to count up from 0 as we have performance, as we have activity. So we go back to the post-closing entries tab. We see that all these accounts are now zero. We've achieved the goal that we demonstrated at the beginning to make all those zeros, so that when we have the first day, when people wake up and they start doing work at 9 in the morning on February 1st, then we can count up from this time period and track our performance for that time period. Note that when we think about this from a theory standpoint, obviously in real life, we haven't really done this on January 31st. It's probably sometime in February. We would have had to make the financial statements, do the adjusting entries. But in theory, that's what's going to happen, right? We need to account for these accounts as of when we count for the month of February. We have to start at 0 and count up from February. And we have to have our system, our accounting system, which might not line up to when we actually enter the journal entries, to account for that in some way. So it might, however the system accounts for that, when we run a report for the income statement for January, or all income statement, balance sheet, equity for January, we need to know what happens when we run a report for February. What happened to these temporary accounts? How do these accounts tie together? Well, in February, all of the capital accounts here that were in January, this balance of $103,600 is where we started for the reports in February. All the income statement numbers in February started from 0 going up, and all the income statement accounts for January had been closed out to the capital account, so that when we started February, when you run reports for February, it's starting with $103,600 in the capital account, and then counting up all these temporary accounts from 0, measuring income for that time period. If we ran a report for the year to date, January and February, then we would see these same numbers, and these accounts would keep counting up for 2 months worth of data as we run reports. So as we start looking at these things in practice, we just have to have an idea of what the closing process is, what these reports will look like, what's going to be a problem if we go back and make journal entries and do things to prior time periods. These are all practical components of items and problems we can get a sense of by having a good understanding of what the closing process is. For more accounting information and accounting courses, visit our website at accountinginstruction.info.